All right, it's December 30th. We are deep in the final trading week of 2025, and the tape just feels strange.
It's that classic holiday mix, isn't it? Quiet volume, but with this intense pressure right under the surface.
Exactly. We're hovering near record highs, but there's no conviction. So today we're doing a deep dive into an institutional brief to see what the big desks are actually thinking.
And not just what they're saying.
Our mission is to figure out if this is a classic Santa Claus rally, that holiday gift that gives us momentum, or if we're all walking into a really dangerous liquidity trap.
And that entire question, it all comes down to one thing today.
Mm.
2:00 p.m. Eastern.
The FOMC meeting minutes.
That's the final catalyst of the year. Every trader, and I mean every trader, is hunting for one thing in those pages. Hawkish dissent.
But wait, a little dissent is always expected, right? Why are these minutes from a meeting where they just held rates suddenly so much more dangerous?
Because the market has gotten completely, almost dangerously complacent about rate cuts in 2026. The entire rally since October has been built on this one assumption.
That the Fed is done and cuts are coming soon.
It's baked in. So if these minutes show that a real minority of the committee is arguing for higher for longer, or even just questioning the need for quick cuts, it just poisons that whole narrative.
Okay, that totally reframes the risk. So the market isn't looking for good news. It's just trying to dodge a bullet.
Precisely. And you can see it in the futures. S&P futures, the ES, they're just flat. It's a wait-and-see tape, which is exactly what thin holiday volume creates. You can feel it.
It feels like a high-stakes tug of war. You've got the seasonal retail inflows trying to push us into record highs.
Pitted directly against institutional distribution. The smart money is quietly taking profits and rebalancing for the first quarter. The sentiment right now is, at best, neutral to defensive.
What's so amazing to me, though, is the macro picture underneath all this. If you just step back from the S&P chart for a second, the foundation looks like it should be massively bullish. But the market's not buying it.
That is the absolute key disconnect. Just look at the bond market. The 10-year Treasury yield is sitting near 3-week lows, right around 4.11%.
Which should be rocket fuel for growth stocks.
Rocket fuel. And then you have the currency market, the dollar index.
The DXY is trading flat near 98.0. But the big story is the annual performance. It's closing out its worst year since 2017. It's down about 10%.
So let me get this straight for everyone listening. We have two huge tailwinds, a falling 10-year yield and a very weak dollar. Big tech should be ripping higher, right? A weaker dollar helps their overseas earnings, lower yields boost their valuation.
And yet big tech is wobbling. It's failing to launch.
Why?
Because it signals a fundamental shift in the market. We've spent years in a world defined by valuation expansion. If you had a good story about AI, investors paid up for future promise.
That phase is over.
It's over. The market has priced in the soft landing. It has priced in the Fed cuts. Now the focus is shifting entirely to earnings execution. Institutions are demanding proof, not promises. You have to show the revenue now. So that changes everything for 2026. Every single trade. If tech can't rally in these perfect conditions, it means we have to really dig into the tactical levels. The technicals become everything.
Exactly. In a thin market like this, those technical levels become self-fulfilling. We have to define the structural floor and the resistance ceiling.
Okay, let's start with the S&P 500 futures, the ES. We've been stalling out right below that big psychological handle, 7,000. The high was 6,994.
7,000 is just noise. It's a round number. The real resistance ceiling, the level that matters, is a bit higher. We're capped until the S&P futures can clear 7,015.
And it has to be on volume.
It must be on volume. A low volume pop doesn't count. A break of 7,015 on volume is a real breakout signal.
And on the downside, what's the line in the sand? Where's the support?
The critical structural floor is at 6,936. This is where the short-term buyers have been stepping in. If we get a confirmed break below 6,936, well, that exposes the 50-day moving average.
Which is way down at 6,848.
A very sharp drop. That would be a serious end-of-year washout.
So 6,936 is the firewall. And what's key here is that when we hit that high of 6,994, the volume was reportedly 30% below the 20-day average.
Which is a classic signature of institutional distribution, not buying enthusiasm. It's the bulls running on fumes, and it confirms that liquidity trap idea.
Okay, so if the S&P is looking tired, what about the Nasdaq 100, the NQ? You called it the canary in the coal mine for tech.
And tech fatigue is, well, it's obvious there. The whole zone between 25,830 and 26,180 has been a supply graveyard since October. Every time we push in there, the sellers come out in force.
What's the must-hold level for the Nasdaq bulls?
25,369. That level absolutely has to hold. If it breaks, the recent bullish W pattern is completely invalidated.
And a break of that pattern would imply a much deeper move down, wouldn't it?
A slide down to 24,660 becomes very possible. And this weakness, it isn't just about the Fed. There's a global macro story here with Japanese bonds, the JGBs.
Right, you mentioned that, the yen carry trade.
Yeah, Japanese government bond yields are up to 2.1%. That might not sound like much, but it puts huge pressure on the yen carry trade.
Where investors borrow cheap yen to buy high-growth U.S. tech.
Exactly. When JGB yields rise, that trade unwinds. Capital flows out of those high-flying Nasdaq names. It's a global liquidity drain that a lot of people miss.
That's a critical point. So if tech is exhausted and global liquidity is draining, where is the money actually going right now?
The rotation is very clear in the pre-market movers. Capital is moving from, let's call it peeper growth, toward two specific areas: tangible value and specialized AI infrastructure.
Tangible value, you mean like physical stuff?
Yes. Look at the sectors. The materials sector, XLB, is the only one hitting fresh annual highs. And it's driven by a real supply squeeze in things like copper, silver, and battery metals.
Okay, so let's get into the specific tickers. Let's start with the big one. Meta Platforms. Meta. It's moving this morning.
Yeah, Meta's catching a bid, which is interesting. The news is they acquired an AI startup called Manus to accelerate what they're calling agentic AI, autonomous software agents.
So this is their big play to shift the narrative.
It's an institutional signal.
Yeah.
They want to be seen as an AI services provider, not just a social media company.
So what's the level that tells us if Wall Street is buying that new narrative?
Reclaiming and holding $595. A hold there signals the market sees this as a real revenue driver. The next stop would be that psychological $600 level.
All right, now for the tangible value side, HighPeak Energy, HPK.
HPK is surging pre-market, up almost 10% on heavy volume. They put out some good news on operational efficiency. For the momentum guys, the bull case is a clean break of $5.05.
And if it's just a low-volume head fake?
Then you get the classic gap and crap. It fails to hold those gains and resets hard, probably back down toward $4.15. It's a high volatility trade today.
Okay, and rounding out the AI infrastructure play, we've got Supermicrocomputer, SMCI.
SMCI is up about 2%. It's still the main pick and shovel play for the AI data center build-out.
Yeah.
Its story is tied to corporate spending, not consumers.
And the level to watch there.
The key resistance is $32.50. If it can get through that, it opens up a path toward $35.
Okay, so let's put it all together. The low volume, the tired technicals, this defensive rotation. What's the final verdict? A rally or a trap?
All the evidence points to a liquidity trap. Retail is chasing headlines, the Santa rally, S&P 7,000, and that thin volume is letting the institutional desks quietly unload their winners.
Leaving the retail buyers holding the bag if things turn. And the one thing that could spring that trap shut is the FOMC minutes at 2:00 p.m., the pain trade.
That's the one. If those minutes reveal a real structural higher for longer split in the Fed, the 10-year yield could spike towards 4.25% this afternoon.
And that's the duration trap. Explain that. Why is that specific move so dangerous to the stocks that have led all year?
Because the trap is that retail is currently long and wrong. They're assuming rates can only go down from here. They're ignoring duration. If yields spike, the highest flying AI growth names, the ones everyone feels safe in, they get hit the hardest.
Their valuations are the most sensitive to higher rates.
It's a mechanical sell-off. The institutional desks pivot instantly to deep value, to energy, which is why you see oil pushing $58 already. And retail gets caught.
So the safest stocks of 2025 suddenly become the most dangerous.
That's the dynamic. And the single trigger to watch for today, the fire alarm for the whole market, is the 4.15% level in the 10-year. If we cross that, the Q4 narrative is over.
So for everyone listening, what's the actionable takeaway for these final hours of trading in 2025?
Be defensive. Do not chase S&P 7,000. Your entire focus should be on two tripwires: the 6,936 support level in the S&P and that 4.15% risk level on the 10-year yield.
If they hold, we consolidate. If they fail, get ready to pivot.
Correct.
All right, one final thought for you to think about as 2025 closes out. The shift we talked about, from valuation expansion to earnings execution, that changes everything for 2026. So here's a simple indicator to track: the performance of the materials sector, XLB, against the Nasdaq NQ. If XLB keeps outperforming NQ into the new year, it means tangible value is in charge, and the era of easy speculative growth is really over. Good luck out there.